Welcome back, everybody. We have Justin here with me again, and we're going to kind of dive into what's going on in the market in the last week or two. Obviously, we've seen a lot of big players maybe blowing up or strategically trying to get loans from other big companies like FTX. So let's start by diving into kind of what's happening from maybe the leverage in the system and liquidation standpoint.
Thanks, Joe. Yeah, it's been a crazy couple of weeks, hasn't it? We've just seen just max pain in the markets, and we're starting to find out the true extent of the losses across the industry. I think everyone at this point has seen that Three Arrows Capital, the notorious hedge fund in crypto, has potentially gone completely insolvent. We don't exactly know the extent of the damage there. They've been kind of hush-hush, but there's been ruminations on Twitter that they're basically at this point 100% out of money and are just liquidating whatever assets they still have to pay off whoever they owe money to. And this has a lot of contagion, as people have been saying, around the industry, because apparently what they've been doing is taking money from startups and managing their treasuries and saying, hey, we'll take the money you raised, we'll give you 8% APY on that, and then we're just going to trade, market make, whatever with that money, essentially turning it into a sort of lending shop. And unfortunately, 3AC was just a little too degen for this bear market, because they got caught up in Luna, they got caught up in staked ETH discount, and they got caught up in just all of these illiquid coins tanking in the bear market that they've now had to sell at depressed prices. So a lot of people have been speculating that 3AC has been one of the biggest forced sellers as the market's been going down, particularly when it comes to Bitcoin and Ether, because they probably collateralized a lot of that Bitcoin and Ether for other loans. And now that they're getting margin calls, they have to sell those. And so we're potentially seeing excessive pain on Bitcoin and Ether because of that. And then it does kind of look like some of these other lending shops like BlockFi and Celsius may have had exposure to Three Arrows. And that is contributing to the problem of them not having the funds to give to customers for withdrawal requests, and that they might be insolvent now. And that if all the customers were to withdraw, everyone would have to take a haircut. It has just truly been brutal out there. And it's really exposed this leverage that probably should have never been there in the first place. I mean, we all know that crypto can do a minus 80, 90%. If you've been around the block, you've seen a couple of these. I certainly have. And I would not leverage up my portfolio during a bull market, certainly when you can have one of these big downturns that causes you to become a forced seller at the bottom. I mean, if anyone was paying attention to the macro over the last 2 years, it was obvious that there was some sort of overvaluation going on and that some sort of bear market was inevitable. So putting on leverage was a really bad move, in my opinion. So for all of these people to get liquidated, I'm really quite appalled at how unprofessional it was and how little risk controls they had. I mean, the fact that most of us just buying some tokens and having a little bit of cash on the side outperformed some of these big players, it's really quite amazing. And, I think it really goes to show just the level of degeneracy out there in some of these traders' minds, that they look great in the bull market, but, the emperor has no clothes in the bear market.
Yeah, I mean, a few things here. One is, it doesn't even matter the level of the AUM you're managing for yourself, right? You could be the guy who's got $1,000, or you could be 3 Arrows who's got billions, right? Same guys make the same mistakes. I mean, greed and FOMO kicks in even with guys that have been managing billions of dollars like 3 Arrows Capital, and they've been in the game long enough to know that, like you mentioned, we've always seen 85% drawdown in a lot of these different assets. So if you're not underwriting that from a portfolio standpoint, then you're not managing risk properly. For all those that are also maybe looking to take out loans against their crypto, that should also give some insight that you probably shouldn't really ever borrow more than maybe a 10%, right?
Yeah.
Against your existing assets, because there can be those 85% drawdowns, as everyone can see. And so you see a lot of people posting on Twitter about their Celsius margin calls on all their loans, right? and they weren't able to top up their loans, and therefore they're getting liquidated. But I think, one of the takeaways we should look at is don't borrow at all, but if you have to, try not to exceed like 10%, right?
Yeah, yeah. I mean, a little bit of leverage is okay. Certainly like 10% leverage, so you're like 1.1x long, things like that. I think is okay as long as you do manage your risk appropriately and you have a way of scaling out as the market goes down, right? So like you need to have a system in play where it's like, okay, if we take a 20% drawdown from the highs, we're going to scale out. We're going to close, half of our leveraged positions. And then if you have further losses, we're going to close the other half, something like that. You need a system where you just start scaling out as the market goes down. And yes, that will mean that sometimes you get whipsawed in these markets that are jumping around. But on the flip side, that means that you're not going to become a forced seller in a bear market like we have today. I think a lot of these people didn't have these proper risk systems in play. And so you had 3AC ride the market all the way down, thinking there was going to be a rally eventually. But little did they know, they and everybody else suddenly became forced sellers and pushed it further down. And so you just have this systemic risk that really crushes everyone. I think this also goes to show how unexpected this bear market was. I mean, I don't think anyone really predicted how bad it would be. Everyone I've talked to seems to be totally caught by surprise at the pace and the absolute brutality of the downside here. I mean, we've just been straight down with no relief in sight from the highs, really. I mean, this really goes to show that it's truly a macroeconomic phenomenon here between the Fed and the recession and everything like that. This is not just isolated to crypto, but yeah, it was really unexpected for everybody. And that's why we have so much leverage being flushed out. But that doesn't give people a pass, of course. They should have known better. They should have known that this tail risk was out there and had systems in place to deleverage before they become a forced seller or before they become, insolvent on their loans. And a lot of these guys are never going to recover. I mean, I don't know who's going to have 3AC manage their money after this, right? Because everyone, is just so notoriously aware of them. And when it comes to the Celsiuses and the BlockFis of the world, they've got a lot of work to do to not only repay their customers, but to repair their name if they want to remain in business and continue to get more customer deposits. And not to mention the regulators that are foaming at the mouth right now, trying to go after them. So it's really done a lot of damage to not only reputation, but the whole industry.
Now, do you think, guys like this, or maybe with Luna, Do Kwon, right? Do you think guys should seek or some part of like jail time or something like that, meaning if they didn't properly give the right disclosures to everybody and the way they're bringing themselves on social media to doing it a little bit differently, or how bullish they are? I mean, where do you kind of draw that accountability line?
Yeah, I think the accountability line, first of all, we need to be careful with it, because I think in the ethos of crypto, we should prefer for crypto to self-regulate, and that for these kinks to be worked out, and that smart contracts and transparency on the blockchain should really be the way that we solve a lot of these issues. If we run to regulators to solve this, we're just reinventing the traditional finance system. There's nothing new here. And I do think that we can be a lot better with blockchain technology in terms of safety and transparency. However, where I draw the line is when people outright lie and fraudulently present what they're doing with customer money. If you look at Terra, there was a lot of misrepresentation by Do Kwon about how the system would work and about the risks, particularly. He seemed to present it as if there was virtually no risk of a systemic collapse of the system, when that was absolutely not the case. And anyone who had even a modicum of understanding of economics could read their white paper and see that this thing had this black swan risk if the market price of Luna had a severe downside event. Then when it comes to Celsius and BlockFi, they were not transparent enough about the risks that their users were presented with. And the fact that they were putting money in things like Badger DAO that got hacked, that was not apparent to the users, that their funds were going into these really low-level projects without much security concerns and not even really a valid use case on long-term yield generation. So that's where I would like to see the regulators come in and slap some wrists, because we really can't have people going around lying about these risks and lying about to the public what they're doing with their money.
Yeah, I feel like from the last cycle, I feel like we're kind of a little bit back to where we were after the last ICO boom, where everyone was like, oh, we need transparency around token releases, token sales, and everything on the websites of these projects. And I still don't think we got that clarity this cycle. Again, I think a lot of stuff's kind of hidden because people, maybe VCs or whoever, may not actually want people to kind of know what those allocations are or for certain price points. But I think something we didn't quite improve on in this cycle enough. And there should be some type of even just standard disclosures or some interface on each website that can outline these different key points.
That would be great. Yeah. I think the whole industry would benefit if there was a standard disclosure about the tokenomics, unlocks, things like that. I feel like it's going to be hard for the regulators to come in and force that without just turning everything into a security and walling it behind, the accredited investor status and essentially just turning it all into like private equity. And, if the regulators come in and do that, it's just going to push everything out into the Wild West where, everyone's just going to be anonymous founders and raising money from, open ICOs, things like that. And then there's still going to be frauds and scams going on. So this is where, again, I think we have to be careful with the regulation and go with the ethos of crypto in that it should be open access, but also transparent. I think transparency is going to be the number one thing to focus on for regulators. Hopefully in the future, we have smart contracts and dApps that people can use to run fundraises that will enforce in contracts the transparency of all these token unlocks. The token unlocks that VCs get, for example, will be viewable in the contracts. You can go on Etherscan and you can go to the contract and you can see when these unlocks are happening. And you don't have to rely on trusting, some white paper that was published 3 years ago, which could have been renegotiated. So that's really the way forward, I think. But in the interim, I do support regulation on transparency and getting that information out there and making sure that if you're going to raise money, at least in the United States, or you're going to take customer deposits and do yield farming and stuff with it, there should be reporting requirements to do that. You shouldn't have to publish monthly, quarterly reports, what have you, on the state of the tokenomics or the state of your balance sheet and the risks at play.
I agree. And, talking about balance sheets, right? Also, it looks like Voyager reveals, based on news article, $655 million exposure to 3 Hours Capital, right? And that's a large amount of money. And then they also taken in a $485 million loan now from Alameda. So it looks like they're trying to bridge the gap until something happens. It'll be interesting to see if they even can collect anything on this and then what happens if they don't, right?
Yeah. This could be further ripples throughout the industry. I'm not too familiar with Voyager or who might be exposed to them, but my guess is similar to 3AC, we could see a bunch of crypto startups lose their treasuries and potentially crypto funds as well that might have had custody to Voyager or had money managed by Voyager. So it remains to be seen how this ripples through the industry. I highly doubt Voyager is going to get all of that money from 3AC because from what I've been hearing about 3AC is they've been ghosting a lot of people that they had money for. And it's most likely because they just don't have the money. They were liquidated and they've been seen dumping staked ETH and things like that because they needed to get the funds to avoid liquidations in other ways. The people have been watching some big like Aave loans on chain thinking it's 3AC. So it remains to be seen how this plays out. And certainly if we have further downside in the markets, we're potentially going to see some more forced sellers.
Do you think Sam Bankman-Fried is going to be looked at as a god in 10 years, meaning the next Warren Buffett, the guy who stepped up in this, call it recessionary like time, extended these loans, ultimately probably took over the companies and they come out on top, in 3 to 5 years as a top player, as they kind of are making acquisitions to kind of become more of a professional platform, I think to include stocks, crypto, and everything.
Yeah, I don't know if I would use the word God, but
I know.
I think he will be looked on as a very successful crypto founder at the end of all this, because from what I can see about Alameda and FTX, they've managed their risk very well. No one has really heard of them suffering any severe losses. I'm sure they were overall exposed to crypto on the long side as this market went down. So I'm sure they took some losses, but it's probably all unrealized. and it's probably things that they're, in a long-term portfolio anyway. I mean, Alameda being a market maker, they are probably mostly delta neutral, and as long as there's volatility, they're making money. So I'm sure that SBF made a lot of money from that, and FTX continues to move forward as a business and get new clients, especially with all the issues going on with Coinbase. And the fact that they're lending money to some of these distressed crypto companies shows that their balance sheet is very strong and that they're taking advantage of the situation by getting exposure to things at depressed prices. Certainly at the end of this, they're going to come out ahead.
Yeah, it'd be interesting to see. What else you think, for everyone that's listening here, what is some feedback on just obviously all these different lenders, portfolio management, and some thoughts into the next few years, what they should do?
Yeah, my thoughts are what they should do is they should emulate Voyager finance, because it's all on chain and we can see what's going on. I'm also a big fan of Maple Finance on Solana, where that is also all on chain, and you can watch the loans and the debt repayments as they come in, and you can, as a depositor, there's a lot of transparency there, and that they are publishing reports about the status of the loans and who they're lending to, and that they've done diligence on all these borrowers. I really like that about Maple. I think that is a good way to go for institutional loans. And then for your generic customer deposit getting yield, I really like the wire finance method of having transparent strategies on chain. You put your USDC into a vault there, and you can see that it's been split up, 10% over here in Aave, 10% in Compound, 10% here and there. And they have regular meetings on risk to things like smart contract hacks and liquidations, depegging, whatever sort of risk they were exposed to. That business model, I'm a huge fan of. And as we've seen, even though we've suffered an incredible bear market, they haven't had any issues. They are still chugging along just fine. And so again, this just comes back to using the blockchain, what it's for, which is transparency and smart contracts to manage these issues and these risks to depositors.
All right. And everyone obviously should take custody of their own assets in some aspect in cold storage, lock them up. Don't worry about a little bit of yield if they don't want to take on more risk, right?
Yeah, absolutely. If you're faced with getting, a couple of percent a year, but exposing yourself to smart contract risk and the risk of, having your wallet online, things like that, it's definitely a hard bargain. You need to think carefully about doing that versus just keeping your tokens in cold storage. So it's definitely something each investor has to evaluate for themselves. Is the yield really worth it? Or is there a chance that you suffer some losses that on average don't make this yield worth it?
All right. That's awesome.
Oh, you want to hit on the bear market rally real quick?
We can do that.
So I guess what's on everybody's mind right now is where is the market going in the next couple of months? Everyone seems to be on edge. After we've already had these big losses, the question is, are we near the bottom or have we passed the bottom? What's going on there? And I'll tell you my thoughts. I mean, I certainly think we could be near the bottom. It's a very real possibility. And I'm a buyer at these prices. I think historically, after a drawdown like this, if you're buying quality, then it will work out in the long term. But given the macroeconomic condition has not really changed for the better, we could still see some downside. And I think if you're buying right now, you need to be prepared for more downside. And if you're finding yourself over leveraged and you could become a forced seller at some point, you need to be looking out for a bear market rally to raise some cash. And I've been hearing a couple ruminations about a bear market rally, some people predicting this based upon the Fed backing off some of their QT and interest rate rise plans, and that kind of giving a little bit of hopium to the markets and giving us the chance of a bear market rally. Certainly, if we see CPI and we see inflation come down over the next month or so, that could signal to the market that it's time to rally, it's time to buy, and that a lot of people will be buying thinking that was the bottom, which it very well could be. But that is how we're going to get a bear market rally. And my strategy is, if you are strapped for cash, if you're not able to survive the next year or two and you're over leveraged in your portfolio, that's a good time to raise cash. Sell some things that you really don't want, that you really don't think are going to survive the bear market. Hold on to your quality but raise some cash, and potentially if we revisit these lows or if we go lower after the rally, then you'll have another chance to get in. And I don't think there's any rush. No one should be in any rush trying to call the Pico bottom. You're never going to be able to do that. And certainly with as long as this macroeconomic recession could take to play out, we'll have plenty of time to buy at depressed prices. And so that's why I always encourage people, if you're getting into the market, you scale in over time, you do a dollar cost average. You don't want to try to just buy all at once at what you think is the bottom. Over time, your average price that you get in will be pretty good over the next 6 to 12 months. So that's my plan, is to scale in over that time frame. And if I see a bear market rally, I'm not really going to get too excited thinking that, oh, we passed the bottom and now it's only up from here. You got to tamper your excitement. I know everyone has in crypto this idea that the cycles happen a lot faster and that we tend to just rally hard off the bottom and have V-shaped recoveries. But given the macroeconomic conditions, I don't really see that as a likelihood. I think it's going to be more of a long, drawn out bear market, the likes that we saw more throughout 2018 after the 2017 highs. So I would just say, prepare your portfolio for a long bear market, have cash at hand or raise cash if you need to in a bear market rally over the next few months, and be in it for the long game. Buy quality, buy things that are here to stick around.
Sell your organs, eggs, whatever you can to get money as we move forward in the bear market, right?
Yeah, sell everything you can because look, the next bull market is going to be absolutely crazy. It's going to be even crazier than the one we just saw, because all the innovation going on in crypto is really setting us up for a truly viral movement. Now that we can handle much more transactions, and now there's much more use cases going on, we're just winding up this spring as time goes on. And the further this bear market goes, the more upside there's going to be in the future for people buying at these lows. So I think if you've got cash, you've got the ability to invest, this is one of the best plays in the investment world right now.
Two things. One is, as I look back at this last cycle, right, Bitcoin was hanging out in the 60s, and we're at all-time point with monetary policy where, everyone had money, right? And looking back, it actually seems like the price is kind of low compared to, what was put into the system. As I look forward, like, what drives that price beyond that? And, a lot of these big players obviously are getting liquidated out of the market, like 3 Arrows or whoever, Celsius or Voyager, whoever was kind of offering these interest rates to depositors and then taking that money and putting in DeFi and boosting the TVL, right? It seems like we definitely could be in for a period of time until maybe new money comes into the system. And who is going to be that new money? What's going to maybe be that catalyst?
Yeah, I think what gets us to the new highs is going to be institutional adoption. Retail is not going to be enough money coming in to really spur that. Especially if we're going into a recession, right? That's going to hurt the retail capital markets' ability to buy. But institutions are still flush with cash. There's still a lot of cash on the sidelines. Some metrics put it at all-time highs in terms of cash savings. And there's a lot of money that wants to get into crypto, but has been waiting for clarity from regulators, or even has been waiting for these sort of depressed prices so that they're not buying what potentially are the highs. And I think once we've seen the markets calm down and we've sort of just been a sideways market for some period of time, and the macroeconomic landscape doesn't look as depressing, and we've flushed out most of the leverage out of the system, which arguably we've already done, I think that's when we're going to start to see a lot more institutions come in. And that is going to give us the new money coming into the space that we need to revisit the highs and beyond. And then retail will only come in once, we've already pumped it up a bit and there's some more FOMO going on, since retail is very, emotional driven. But I think the next cycle is really going to be focused on getting this institutional adoption, having a lot of these burgeoning, institutional providers like Fireblocks or the Maple Finances of the world doing institutional lending, all of that becoming more solidified and getting regulatory clarity and signing up more and more institutions into the system. Hey, maybe we even get a big Bitcoin ETF by the time the next cycle comes around, right? I think there is a lot of financial plumbing from the traditional finance world that will be here by the time we get to the next cycle, which, anywhere from 2 to 5 years from now. But by that time, we will have wound the spring up for new highs. And I think this thing is going to be an explosive bull market, just like the last two. And I think now is a good time to prepare your portfolio for that.
Well, I appreciate that. I'm a buyer, right? I'm a buyer on the dips.
That's the way to do it.